Yes, sir.
Okay, thank you. Thank you so much. I hope you all are safe, and I can just not an advice, just for a sort of sharing. Don't go the play anywhere unnecessary, because we are in the verge of the fourth wave. Its number of cases are increasing. So better time to study. This is actually these times I am reading the books, because I have a lot of times I don't go anywhere. Just stay at home and read the book. So you can at the same way you can study the study materials and prepare yourself for exam. That's sort of uh, winning situations can be created. Okay, having that thought, I am moving to the today's topic. Today we are going to start with a new topic called risk management. So far we have discussed about the incorporation of a company and some company law act provisions and all we have discussed, and then we have discussed about the licensing of financial institutions and shareholders rights and power, then liquidations. So all these four topics are discussed sort of introduction to the topic, before to the subject, before entering into the in a detailed manner. We have discussed these things as a introduction, and exam point of view. There were questions, but not that much. But from this point of word onwards, all the topics are very important. For example, today we are going to discuss about the risk management. If you are thorough with the risk management topic and theories, you can earn at least 22 marks, maximum 42 marks to 44 marks you can earn, because there are compulsory there will be a one questions about the risk management. It's a 20 marks structural question, so there will be a four sub questions will be in one main question, and each has 5 marks, so altogether 20 marks. And in the first section also, in the first question also, definitely there will be one sub questions will be there, so 2 marks. So you can easily earn 22 marks from this topic, risk management. And maximum in some year, some semesters, there were 2 questions in the risk management, and there were 2 questions in the first question as well. So that's what I say, that minimum you can earn 22 marks, maximum you can go for a 44 marks, depend on the structure of the paper. So exam point of view, this risk management is so important. So actually this topic I have structured into 3 classes. The first 2 classes I will discuss on the theory, okay, and the related topics and the risk management and risk process and all sort of things. And then in the third class I will discuss on the papers, past paper questions. So you can if you can answer those past paper question at the third class, then of course you can be confident that you can get the 22 marks from the exam. So if you study the risk management, compliance or corporate governance and all, easily the pass marks will come. So but that's not our target. We have to get the good marks. So just study everything, but I'm just saying that this is sort of our buffer, or just a sort of comfort zone, so we have to secure that. Okay, having that note, I'm going to move to the next the discussion, the topic discussion. Before that, if anybody has the question on the previous topic, the last class or previous class, if you have any doubt, you can raise now. Even later on you can raise, but I'm giving some time to you all to raise any questions or any doubt you all are having in the previous class, the last Wednesday class or last Saturday class. If you don't have the questions, then I can straightly go for today's discussion. And this is again reiterating that Even you can unmute your microphones and ask the question, or you can send the message through the chat box. So there is a 2 ways are there. Is anybody have the questions or anything? Any doubt or anything you wanted to clarify? Then I can just, or otherwise I'll move to the risk management topic. Okay, since nobody raised the questions, I am moving to the today's topic, the risk management. So before entering into the risk management, just we will have some idea about the risk management. What is risk? What is risk? Okay, before going to these things, just in a simple term, can somebody say what is risk? Okay, this can be called as a future adverse event. Future adverse event that is likely to happen, or there should be a probability to happen that future adverse event, then that is called as a risk. In a simple way, I can explain to you. You are starting to go to the office from your home. Okay, then you are planning that, okay, within half an hour, within 1 hour period, 1 hour time period, I can reach to the office. That is your expected outcome. To reach in your car, you reach the office within half an hour, 1 hour period to the office. Okay. If everything goes smooth, then there is no issue. But the risk is the circumstances where sometimes the vehicle may get breakdown during the journey, or sometimes vehicle may get the accident. So sometimes there may be closed down of the some roads are heavy traffic. Then you could not reach the office as expected in 1 hour time. So in your journey, this from going from home to office, there may be 3 risks get involved. Generally, we can say 3 risks. One is breakdown of the vehicle, or second one is we can say that met with an accident or huge traffic block, or due to the closure of road or some other reasons. These events may happen or may not happen. Then that is called the risk. Okay. If we know that definitely that will happen, then that is not called as a risk. The risk is the probability. There should be the event should be probability, should be a probable event. It may happen or not happen. If everyone knows that this will happen, then that is not called as a risk. That is the main thing you have to keep in your mind. Okay. So with that understanding, if we go to the definition, proper definition, what is risk? The effect of future uncertainty on achieving desired outcome. In my example, the desired outcome is within 1 hour period, I am reaching to the office by car. Okay. But there may be some uncertainty, future uncertainties are there. What are those uncertainties? Break down the vehicle, or traffic block, or something called with an accident. So these type of uncertain events, future uncertainty, is called the risk. This is a general example. I can give an example related to our topic or related to your profession or something to give more clarity. For example, okay, we are working in a bank. So you are working in a bank, the investment division, and the management give there's a 100 million excess fund. Okay, 100 million excess fund. We need to invest. We had to find some investments where the expected return is 10%. Okay, the bank management saying there's excess fund of 100 million, excess liquidity of 100 million. We can block for 1 year. So our expected return is 10%. Find the investment. Okay, in that circumstances, what you are doing is you are finding some investments. Okay, the first you can say that select option. First option would be you can invest in the government securities. Okay, but currently the government securities expected return is something below, because generally if it is 1 year, what is that 1 year treasury bill rates? As a financial students, you may know, you may have to have some idea. The roughly what is the 1 year treasury bill rates? Come on, students. I am just because this is not just studying the theory or anything. I just already discussed with you, or already told you. You'll have to, as in your blood and vein, you should have the financial flavor and market and what's happening in the economy and all. Yeah, exactly. Around 5%, 5.2. So that actually I like to congratulate that person who is following the treasury bill rates and all. Actually, this is the way you will have to have in the current. So the expected return is 5%, 5 to so sorry, the actual return would be 5 to 2%, but 5.2%, but our expected return is 10%. Then we can't invest in the, or we can't select that, or you can't select that first option of investing in treasury bills. Okay, then second option would be investing in treasury government debentures, sorry, corporate debentures. In the corporate debentures, of course, now the return would be close to 10%, but you have to block the money for 5 years. Okay, then that option also going out. Then third option is investing in stock market. Okay, now stock market is going a good way, so you can invest in a stock market. So you are okay. There are 3 options available to you. The and other option also, you can take that deposit in a bank. That of course you are, if you are in a bank, then of course that option is not available. Then you are deciding to invest in the stock market. That is the option you are expecting. So in that option, your expected return is 10%. So you are going to invest 100 million. Then after 1 year period, 110 million you are expecting from that return. There may be several scenarios. There may be several outcomes in that actual outcome from that investment. The first outcome, you are expecting 110 million, but the stock market is working or performing good, and sometimes the return may be 120 million. Then in that case, of course, we don't have any issue. Then second option would be the stock market is not perform well, and due to some reasons, sovereign rating downgrade and all sort of this economic condition and all sort of things. So you are set of companies, your portfolio doesn't perform that companies. So you may get sometime 107 million. So, and third option would be, even you could not able to get the 100 million, even the prices, your company prices, portfolio prices go down. So you may get sometime 95 million as a after 1 year period, because of some crash in the stock market or your portfolio company. So the first option, of course, there is no risk, because it's a favorable. You are expecting 10% return, 110 million, but the actual return is 120 million. That is out, because that is not considered considered as a risk, because it's not an adverse event. That's what why I'm explaining this example is to emphasize that my idea. It should be an adverse event. Okay, but the first option is not an adverse event. It's considered as a risk. But second and third option could be considered as a risk. The second option, you are expecting actual return, expected return is 10 million, but you are getting only 7 million as a return. Then that is considered as a risk. And third, of course, is the risk because your expected return is 110 million, but actually even you are losing some of your capital amount also, you are getting just 95 million. So those two are considered as a risk in that investments. That is, I'm calling the sort of risk. So that's why in the second bullet point, I'm saying that the difference between an investment's actual return and the expected return is called as a risk. Okay, the expected return is 110 million, but the second and third scenario, our actual return is less than 110 million. So somebody may ask that why sir, the first option also there is a difference. Why can't we call that also as a risk? No, of course no, because that event should be an adverse event. If it is a favorable event, then that will not be considered as a risk. So the adverse difference between investment actual return from the expected return is called risk. The risk includes the possibility of losing some or all of its original investment also. Our third scenario also considered as a risk. So in the term risk, there are two things important. The first one is uncertainty. An event may or may not happen. In our equity investments, we know that event, the second and third option, or even first, may happen or may not happen. We don't know what will be the direction in the future. And again, loss. An event has the unwarranted consequences of losses. So those two characteristics should be there in the risk. First one is unlike the uncertainty, other one is loss or adverse impact. Then that is called as a risk. Okay, now we have discussed about the risk because I am just going very deeply because this is a topic we can just, for the exam point of view, it's an important. Even sometimes that's a question about what is risk for 2 marks. As one of the first question, then you have to answer. If you have any doubt, you can ask. Or otherwise, I'll just move to the next slides. Okay. Then we have studied about the risk, and I think you are clear about what is risk. And there's a second one is risk management. Okay. We know that there is a risk, and we are going to manage the risk. What is risk management? In the financial world, risk management refers to the practice of identifying the potential risk in advance, analyzing and assessing them, taking precautionary steps to mitigate the risk, and continuously monitor it is called as a risk management. We will discuss this later on in the detail manner. Okay, we know that risk. Okay, then what is called risk management? Identify the risk, analyze the risk, and taking precautionary steps. That means control the risk and more continuously monitoring the risk. These 4 events are comprising the risk management. This is called even the risk process also. The call as including these 4 practices, but in the risk management, it refers to the practice of identifying potential risk in advance, because when we are investing, when we are making an investment, or then at that point in advance, we have to identify what are the potential risks could arise. If I am actually, I just example to you all, give an example, equity market example. If you take the, if you have the example of investing in treasury bills and treasury bond, of course, there is no default risk, but there will be a interest rate risk. They have to mark to market, then based on the interest rate adjustments, the fair value will be changed. So the difference. So the identifying the potential risk in advance, analyzing in the sense, okay, if these scenarios are happened, what would be the losses? Then analyzing and assessing them and taking precautionary step. We will study. We will discuss about it. What are the precautionary steps can be taken to mitigate the risk, and continuously monitor it, because the risk management is not a one-step process. You have to continuously monitor it, because time to time the things will be, circumstances or condition may be changing. So you have to continuously monitor it and see whether is there any change in the risk framework, not framework, risk factors. Okay. Then second bullet point I have mentioned, risk is inseparable from return. Whenever you are expecting a return, the risk is always, definitely there will be a risk. Every investment involves some degree of risk, which is considered sometimes, which is considered to close to zero in case of treasury bill, or very high for investment like equities. There are two messages you have to get it from this bullet point. First one is, if the return is always connected with the risk. If you expect some return, always you have to connect with the risk. There will be some risk. But they are saying that some risks are close to zero. Some investments or some activities may have close to zero risk. For example, treasury bill. Even the last class I have explained to you all, there is no zero risk, of course, the close to zero risk. And very high, if it is equity, it's a very high risk. Okay, so every investment, every return will involve with some sort of risk. That is the idea you have to get it. And risk is quantifiable both in absolute and in relative terms. Okay, based on the probability, you can quantify the risk, absolute term as well as relative term. Relative term in the sense, this is the way that when you invest in the equity, you will have the high risk compared to the government securities. When you are investing in corporate debenture, you will have a higher risk when compared to the treasury bill. So there's in the relative term also you can quantify the risk, or sometime in the absolute term also. A solid understanding of risk in its different form can help the investors to better understand on opportunities, trade-off, and cost involved with different investment approaches. Okay, so the better understanding of the risk is important for an investment manager. So this is called the risk management. So next one is, we are going to discuss about the risk management process in a detailed manner. Before going to that, if anybody has the question, I can answer. Anybody? Okay. Since there is no questions, I am moving to the next slide. We have already discussed about the risk, what is risk and what is risk management. When we are seeing the risk management definition, we saw that there are 4 processes in the risk management, which is called risk management process. Okay, the first one is identification. What is the risk? The second one is assessment. Okay, what would be the impact assessment? And third one is control. Fourth one is monitoring. Let's take a simple example, a previous example. We are investing 100 million rupees. Then we expect the 10% return. That is the management expectation, because their cost of fund is 9%. So they are expecting 1% more than that. Okay, in that, so you are the investment manager. So first you have to identify the risk. So you are, as I explained to you all, you are assessing that sometimes we may get the 120, sometimes we may get the 107, sometimes we may get the 95. So we know that what are the risks get involved and what are the risk could be there. There may be default risk, there may be interest rate risk, there may be some operational risk. We will discuss those things. So first event, they have the particular manager, fund manager or investor has to identify the risk in advance. So once they identify there may be 3 scenarios, then they will assess the likelihood. Okay, for the first event, for the getting 120 million as a return, what would be the likelihood? Okay, let's say 30% of the chances or 40% of the chances are saying that we can get 120 million as a return. Likelihood, 40% of the chance. And then there's another 30% of the chance we may get the 107 million. Then there is other 40-70A, then another 30%. There's a chance of even lose the capital and get only 95 million as a return. So now assessing that, okay, what would be the scenarios? What would be the likelihood of this? So we are assessing the total impact to the company or for the particular fund. Okay, so that is called assessment. Then third one is monitoring or controlling the risk. And controlling the risk means, okay, we know that if we invest in the treasury bills or invest in the equities, we may get the 120 million or sometimes we may get the 95 million. In that scenario would be very adverse scenario. So to safeguard that, we may invest 50 million into the equity market and another 50 million into the government bond market. Then that will give sort of balance the risk, because in the if we invest in the government securities market, the treasury bill market, return is very low, but fund is 100% secure. If the balance, then if we invest in the equity market, return may be high, but high risk. So balance the risk. What we are doing is we are just taking the control measure. So diversify the risk investment into two equity, 50% equity, 50% government securities. Then continuously monitor, because we have invested in the government share, invest in the equity market. Sometimes equity markets time to time, weekly to week, it's getting changes. So we are continuously monitor whether our fund is secure. Is there any adverse, further adverse scenarios are getting, or do we need to diversify that investment into some other things here? So we have to monitor it. Okay, so these four processes are involved. These 4 steps are involved in the risk management process: identification, assessment, control, and monitoring. There were questions in the past exam papers related to what is risk management process. Then you have to answer these 4 steps. In some literature, sometimes these steps may be mentioned as a 5 steps or 3 steps, but generally it's a 4 step, because sometimes they control and monitoring, they are taking together and saying that there are 3 processes: identification, assessment, controlling, and monitoring. Or some cases they are dividing into 5. So, but in generally accepted steps are 4: identification, assessment, controlling, and monitoring. We are going to see that is in a very detailed manner. The identify the risk. There are many types of different type of risk are involved. The credit risk, market risk, liquidity risk, operational risk, legal risk, strategic risk, environmental risk, regulatory risk, much more. It is important to identify as many of these risk factors as possible. When we are making an investment, actually, don't get afraid about this risk type, because we will discuss what is credit risk, what is market risk and all. There may be several risks when you are investing in a portfolio. There may be several risks. First one is credit risk. What is credit risk? If we could not get money again, the defaulted, if we invested that counterparty defaulted, that may get involved credit risk. The market risk. The market risk may be interest rate risk or price risk. And liquidity risk. Liquidity risk in the sense, whenever we need the money, immediately if we cannot get that particular investment into liquid assets, then that may create a liquidity risk. And operational risk, there are several operational type of risk and legal risk and so etc. We will discuss that. So first, at an initial point, when the investor makes the investment, he has to identify what are the risks is involved in a particular investment. For example, I can just wanted to give us some more idea. When an investor investing in the stock market, then he is investing in. He has to check whether what type of credit risk may involve. That, for example, if he investing 100 million into particular company shares and company going to the bankruptcy, then he could not get back that 100 million. That's involved, of course, credit risk, the sort of default. But again, he can think about the environmental risk. Particular company may expose to some environmental regulations. So due to that, there are huge losses incurred by that company, and the company share value may go wrong. May go down. So in that case, environmental risk get involved. Or just when a bank make an investment new project, environmental risk may get involved. Sometimes regulatory risk may get involved. Regulators may impose some conditions or limitations. So those type of risk, well in advance at the time of investment, they have to identify. The second one is analyze the risk. That's what I say, that the second point is they have to analyze, okay, what would be the total losses and what would be the likelihood and impact. Actually, when they are analyzing, they have to analyze the two things: the likelihood and impact. Likelihood means what is the possibility of occur that particular risk, and okay, if that particular risk occur, what would be the impact. If my example, if it is option 2 occur, the impact occur, then he will get 107 million. So 3 million will be the loss. So not loss, no, the difference between the expected outcome and actual outcome. If it is the third scenario, they may lose even some capital amount, the loss would be the high. So they have to analyze the impact. And then control, of course, I have explained to you all that to eliminate the risk, what they have to do is they have to mitigate the risk factors and diversify the portfolio, and then monitor the risk. Okay, monitor in the sense when it's getting changed, they have to control. They have to change the control measures. So these 4 steps are get involved in the risk management process. Okay. So we have discussed about the what is risk and then risk management. Now we are discussing about the risk management process. In the risk management process, there are 4 steps getting involved. Okay. Any doubt you all wanted to ask from me? I'm ready to answer. Or shall I ask a question from you? Since you all don't ask the question, just to get the feedback. You are a fund manager. In a particular finance institution, you are a fund manager. Then particular investor, your manager, your senior officer, DGM or AGM, he said that, okay, there's excess money of 100 million. I need this much of return. But there should not be any risk. There should not be any risk in your investment. Okay. My question is it possible to make an investment without any risk? Are you clear? I'm asking your senior management. Yeah.
No,
yes, there are answers. No, that is absolutely right answer. Because in any risk, so any risk, there are some sort of risk. Any investment, there are some sort of risk get involved. Actually, I'm happy. There are several responses here saying that no. Then you are on the track. So actually, we can't eliminate the risk completely. Better, actually, we have to mitigate the risk in the sense we have to mitigate into reduce the risk level, but we can't completely eliminate. It's not possible at all. Actually, this poverty alleviation also, we can't eliminate the poverty from a country. There may be some level of poverty will be in any country. We can't eliminate it, but we can reduce the poverty level. This is in economic, we are just discussing about. Likewise, we can't eliminate the risk. There may be some risk, some sort of risk will be there, but it may be close to zero. Okay. Then I'm moving to the various category of risk classification. In the risk identification, I have mentioned you all that there are several risks could involve. Then that risk could be discussed. Actually, there are main category of risk classification. The first one is financial risk. Second one is non-financial risk. The financial risk involve 3 types of risk. What is financial risk? Financial risk is the risk that affect the balance sheet of the company directly. That is the definition of financial risk. The risk is the danger of possibility of shareholders, investors, or other financial stakeholders will lose the money. Okay, there are 2 categories of risk. The first one is financial risk. Second one is non-financial risk. Conventionally, the banking sector or financial business are considered or give focus on financial risk. But the modern theories are saying that not only financial risk, non-financial risk also as much as important for a bank and financial institutions. The financial risk, we can simply say that in any risk which affect the balance sheet of the particular financial institution, which directly affect the balance sheet of the particular financial institution, which is called financial risk. In the financial risk, there are 3 types of risk: credit risk, market risk, liquidity risk. You can Just you can just say that if what is financial risk, you can say that any type of risk which directly impact the balance sheet of the particular financial institution, which is called financial risk. And financial risk has three categories: credit risk, market risk, and liquidity risk. There are some other risk which is non-financial risk, which is other than these three risks. All other risks are called as a non-financial risk. The non-financial risk, you can't limit the type of risk. Actually, it is sort of infinity. You can expand in numerous ways. It may be operational risk, it may be legal or reputation, regulation, strategic, environmental. Likewise, there are several risks are getting involved in the non-financial risk. We will discuss that later on, I think down the line. So now we have seen about what is financial risk. Is any risk that directly affect the balance sheet of the company. Actually, students, you will just include the word here. In the first bullet point, financial risk is the risk that directly affect the balance sheet of the company. The risk is danger or possibility that shareholder, investor, other financial stakeholder will lose the money, then that is called financial risk. For example, a bank or finance company grant the loans and advances. And that loan, when the particular bank, when particular bank grant the loans to a particular company X, and due to some reason company X default that repayment, then that will create a credit risk to this particular bank. When they create a credit risk to particular bank, then the bank, what bank has to do is, bank has to make the provision for that particular loan, or they have to write off the loan. When they are making provision or when they are writing off that loans, that will directly impact the balance sheet of the particular bank. So that is why we are calling the financial risk is the risk that affect the balance sheet of the company directly. In other way, you can say that you are invested, the bank, particular bank invest in the treasury bills or treasury bonds, and due to the fair value or accounting standard, they are going for a fair value, and interest rate adjustments may affect the particular bonds fair value, the fair value, then that may hit the balance sheet of the particular bank. So you can easily say it's a very simple definition, the financial risk, and there are only three risks getting involved in the financial risk. We will discuss this credit risk in detail manner. And characteristics of the financial risk, it generally related to likelihood of losing money. Actually, in any risk, it may be financial risk or reputation risk, there may be three impact. Okay, we are talking about the risk, and always so far I gave the example to you all. All the examples are lead to a losing of money or loss of money. But generally in the risk, there may be three impact that could created from a risk. What are those? First one is losing money. Okay, losing money is the first one, or financial losses. The second one is reputational losses. Actually, that won't arise through the financial risk. It can be arise through a non-financial risk. For example, there's a huge fraud occur in a financial institution, or sometimes let's assume their database has been hacked by some hackers, and all the customers' information has been leaked out. So that may create a lot of reputational loss to the bank. So first one is financial loss. Second one is reputational loss. Third one is business continuity. Sometimes there may be an instance, or there may be some risk which may lead to a business continuity. For example, you are having sort of very good co-banking system. Suddenly, the co-banking system got struck for 1 or 2 days. You may not get continue that business because of the co-banking system. You don't have the backup or something. Let's assume. In that case, business continuity will get affected. Or sometimes you are getting involved with some fraudulent activity in the board of directors and all, or some violation. Then central bank says that to suspend the business for some period. In that case, the business continuity will get affected. So in any risk, there may be 3 repercussions, 3 losses could arise. One is financial loss, second one is reputational loss, third one is business continuity loss. Here, the first characteristics of the financial risk is generally related to likelihood of losing money. It means financial losses. So financial risk may create financial losses. That is the message I wanted to give you as one of the characteristic of financial risk. The second one is financial risk, most commonly referred to is the possibility that a company cash flow will prove inadequate to meet its obligations. So generally, when the company, it may affect the company's cash flow or bank cash flow when there's a financial risk. And third one is credit risk, liquidity risk, asset-backed risk, and foreign investment risk, equity risk, currency risk are all common form of financial risk. Even though here I am mentioning that this credit risk, liquidity risk, asset-backed risk, foreign investment risk, equity risk, and currency risk, but this asset-backed risk, foreign investment risk, equity risk, and currency risk, all these risks can be called as a market risk, because market risk has several sub-classifications. So generally, the financial risk are credit risk, liquidity risk, and market risk. Market risk has several. Actually, the credit risk also can be segregated into several categories, mainly 2 categories. We will discuss that later on. So these 3. So these 3 characteristics are available in the financial risk. Financial risk. Before going to the credit risk and all, if you have any questions, I can answer. Okay, then I am moving to the credit risk. Because in the financial risk, we have seen there are 3 types of risk mainly involved. First one is credit risk. Second one is liquidity risk or market risk, and third one is liquidity risk. First, we are seeing the credit risk. Credit risk is the possibility of lost money resulting from a borrower's failure to repay a loan or meet contractual obligation. That is called credit risk. I already gave you all an example. A bank grant the loans to a particular customer, and first a particular customer failed to repay the particular loan or meet the contractual obligations, then that risk is called credit risk. Traditionally, it refers to the risk that lender may not receive the own principal or interest, which result in the interpretation of cash flow and increase the cost for collections. So generally, the credit risk get involved with the cash flow. When there's a credit risk, that may affect the cash flow, and that may lead to a liquidity risk of a particular financial institution. Although it's impossible to know exactly who will default on obligation, properly assessing and managing credit risk can lessen the severity of losses. Actually, when a bank doesn't know, when bank grant the loans to customers, the particular bank doesn't know which customer will default, which customer will repay properly. If they know, of course, they need not expose the credit risk. They can just grant to the good customers. But proper assessment. What are the assessment they are having? Generally, to assess the customers. To assess the customers, what are the assessing method the bank is having? Okay, for example, if a customer going to the bank and approaching the bank and asking the loans, a particular amount of loans, okay, to assess the particular customer. Let's assume he's a new customer to the particular bank. What are the methods they can use? Yeah, CRIP or 5C. That's the thing. There are different methods available. Internal rating method is one thing. Internal rating method means the particular bank may have some internal scoring system based on the financial and other things. They can put the scoring system and assess the particular customers with. For example, I'm a person. I'm receiving the loans and advance. I'm receiving the salary of just 50,000. Then I am asking a loans to get a. The repayment. The monthly repayment will be 45,000. Definitely, I will default. So based on their salary particulars and all or financial position, bank may assess the risk of particular loans. That is one way. If it is the company may have that. Excuse me. Sorry for the interruption. So company may have different credit rating. So at that credit rating also, the particular bank can evaluate. Or as one of the students mentioned, CRIP. CRIP is also one of the method. Okay, based on their track record can be raised through the CRIP report. Now I think this CRIP is I don't know whether anybody knows that. I heard about that CRIP is going to give some scoring system for the personal for a person or companies which have the records with the CRIP. So likewise, it start with some 900 or something, and it will reduce. So they based on the historical data, they are going to evaluate the particular person's credit worthiness, and then based on that the CRIP is trying to give a personal assessment report, personal rating report. In the foreign country, of course, you can get a personal rating. For example, if I am going and asking my rating, they will assess based on my past record, my utility payment records and all. They will assess my credit worthiness and they will give a score. Likewise, the CRIP also going to introduce. I heard about. I'm not much sure about it, but I heard about it. Okay, the final point, which is the most important point, the credit risk mainly include both default risk and concentration risk. This is something important to you all to understand. So far we have said the borrowers get the loans and he failed to repay the loan, which is considered as a default risk. But concentration risk is something different. What is the meaning of concentration risk? The concentration risk is the loans, the particular bank and finance institution grant a substantial amount of loans and advances to a particular customer or to a particular sector. Then that may create a concentration risk. For example, in Sri Lanka, if you see in Sri Lanka, more than 20% of the, I'm saying that as a whole, banking industry as a whole, more than 20% of the loans and advances granted to consumption purpose. That is sort of high concentration. Other way around, for example, the infrastructure or real estate purpose, they are granting sizable amount of loan. That is create a concentration risk. I can explain to you the concentration risk in simple way. Let's assume one bank which grant 75% of its loan to the tourism industry. Okay, let's assume, okay, a particular bank grant 75% of their loan portfolio into the tourism industry. Maybe, of course, several companies, but all are in the tourism industry companies. What will happen now? Because due to the issues in the tourism sector, due to the COVID-19 cases and earlier the Easter Sunday attack, all these tourism got affected from 2019 onwards. Then they are struggling to repay the loans. So that concentration may affect the particular bank and finance institution. I think now you all got the point of the concentration risk. Okay, just to check whether you have a clear understanding about the concentration, I'm asking a question. Let's assume two banks. One is bank A, other one is bank B. The bank A grant its all the loans and advances to only 10 customers, 10 good customers. Okay, 10 customers, they are not good customers. We can't say that. They are granting loans to 10 customers. The entire loans are being granted to 10 customers of bank A. The bank B, which grant the loans to 500 customers. Okay, their entire loans and advances, they have granted to the 500 customers. Let's assume both has the same amount of portfolio, maybe 500 million, 500 million. Okay, in that scenario, which bank will have more concentration risk, or which bank is exposed to more concentration risk, whether bank A or bank B? The bank A is giving all the loans to only 10 customers, among 10 customers, and bank B is given their loan portfolio into 500 customers. Which bank will have more concentration risk? Yes, of course, the bank A, because the bank A's loan portfolio concentrated into 10 customers. If one customer get failed, let's assume the equal loans, one customer get failed, the particular bank's portfolio will be, or the NPL rate would be 10%. But in case of the bank B, they have granted 500 customers. If even 2 or 3 customers fail to repay, the NPL ratio will not increase that much. So the credit, that is called the concentration. So bank A is exposed to higher concentration risk. So the credit risk can be divided into two categories. First, default risk, other one is concentration risk. I think you all got the point about the default and concentration. That's what I just wanted. I am explaining to a very, very detailed manner to get that idea. Even that will help you to work to your work environment as well. Okay. Then just we move to the market risk. The market risk is the risk that the value of the investment will increase due to changes in market factors. Okay, the market factors may be prices. If it is an equity market, prices may get changed. If it is the other fixed income investments, interest rate may change, market factors, interest rate and prices. Okay, due to the changes in market factor, the investment value of the investment will decrease. That is called market risk. Okay, I am asking a question from you. For example, if I am having a treasury bond investment, the market interest rate may affect the value of my investment. Okay, what is the relationship between the treasury interest rate and the value of the investment? I'm just asking whether is anybody knows that. You can answer. Otherwise, I will explain to you. There's no harm. I just asking you the question to just to understand whether you are getting the point. What is the relationship between the value of investment and interest rate? What is the relationship? If you are accounting students, you all know that, I think. What is the relationship between the, yeah, I am one of the students asking the repeat the questions. Actually, I am having the investment in the treasury bonds. Okay, and I'm saying that the treasury bond investment value, the fair value of that particular investment will get changed due to the interest rate fluctuation. Okay, now I am asking the questions. What is the relationship between the interest rate and fair value or value of the investment? What is the, whether it is the inverse relationship or positive relationship? You have to give one answer, whether it's an inverse relationship or positive relationship. It means inverse relationship means when interest rates going up, the value will come down. When interest rate coming down, the value will go up. That is inverse relationship. If it is a positive relationship, when interest rates going up, value of the investment also will go up. When interest rate coming down, value of the investment is also coming down. That is a positive relation. My question is whether there's an inverse relationship or positive relationship prevail between the interest rate and value of the investments. Yes, exactly. There's an inverse relationship between the interest rate and value of the investment. When the interest rates are increasing, value will come down. When the investment and the interest rates are coming down, value will go up. So the market risk is a risk. Value of the investment will decrease due to the changes in market factors. So in that case, when interest rate is increasing, the value will decrease. Actually, the treasury bond investment or fixed income investment will get exposed to interest rate when increasing interest rate scenario. Got the point? Okay. These factors will have an impact on overall performance of the financial market and can only be reduced by diversification into assets that are not correlated with the market, such as certain alternative asset classes. What here I am mentioning is that factors, the interest rate risk or price risk, particularly the interest rate risk, it's a market factor. It is not only for you, it is for entire market. The market risk, the reason is factors are applicable for entire market. For example, you are granting the loans and advances to a particular customer X. Then if the customer X defaulted, that will affect only to your company, that relationship between your company and the customer X. But market risk is not that actually. The market risk is if it is the interest rate going up, for everybody the interest rate will going up. And interest rate coming down, for everybody will interest rate coming down. And in the prices of stock market prices also more or less same. So this is the market factor. So how can you reduce the risk is just diversify the portfolio. Actually, diversifying the portfolio is one of the main factor to mitigate the market risk. Diversifying meaning You can invest, as I mentioned already, you can invest something in the government securities, some are in the corporate debenture, some are in the equity market, some are in the fixed deposits. Likewise, you can diversify. Even some are in the commodities, you can diversify the investment. By diversifying your investment, you can reduce the market risk. So that is the one. Actually, there was a question in the past paper. How can we reduce the market risk? What is the technique? Actually, diversify the portfolio is one of the main technique to reduce the market risk. The market risk is something called systematic risk, because it's related to the factors such as recession and that impact the entire market. That's what I have already explained to you. The market risk is called systematic risk because that is applicable to entire market. The market risk include interest rate risk, equity risk, currency risk, inflation risk, commodity risk, and all the things. Okay, I think you have got the point. Any questions you can ask? Okay, students, just to get a sort of maybe related to this topic, or maybe it will enhance your knowledge, I'm just asking from you, what is the meaning of real interest rate? What is the meaning of real interest rate? Or just give a formula. What is the meaning of real interest rate? I'm talking about the interest rate, market interest rate, and all. Okay, market interest rate, of course, everybody knows that. What is the meaning of real interest rate? Interest rates deducted against interest. No, there was there's a correct answer. The interest rate minus inflation. That the student also changed that the inflation. Yes, exactly. The real interest rate mean in the market interest rate or particular interest rate minus inflation is called real interest rate. Because when you are investing, the real interest rate is matters the investment decision. For example, you are having 100 and now currently, unfortunately, in Sri Lanka, we are facing sort of negative real interest rate scenario. Our bank deposit rates are nearly 4.5% to 5%, but our inflation, based on the national NCPI, our inflation rate is nearly 6.1%. So we are having sort of negative interest of 1% or something. But that means when you are investing your 1,000 rupees, okay, you may get 1,050 rupees after 1 year. But based on the inflation, your real value of that money will go down below the 1,000. So when you are making the investment, you have to be mindful of the real interest rate. Okay, but when we are for the risk purpose, we can calculate the market interest rate, which is prevail in the market, the general interest rate. But it's better to keep in mind what is real interest rate. That is good. Okay, then I'm moving to the next one, which is the liquidity risk, the last risk of financial risk. So in the financial risk, first we have seen the credit risk, second one is market risk, and third one is liquidity risk. The liquidity risk, of course, okay, it was considered as a one of the financial risk, but after the global financial crisis, this liquidity risk got more prominent because the 2008 and 9 financial crisis mainly triggered through the liquidity risk. So the liquidity risk become more important. Even you all may know that the Basel document, the Basel III, they are talking about the liquidity risk, and they have introduced a ratio called liquidity coverage ratio, which of course someone too much. I think we will discuss later on if time permits. But you may have to keep in your mind liquidity risk become more prominent after the global financial crisis. The liquidity risk is a risk that company or bank may unable to meet short-term financial demands. Okay, keep the definition in very remind, because there is a question frequently there's a question coming that in the short notes, the difference between the liquidity risk and solvency risk. So better keep it in mind or memorize it. What is liquidity risk? Liquidity risk is a risk the company or bank may be unable to meet short-term financial demands, which is called liquidity risk. The solvency risk, of course, we have already seen. What is solvency risk? The bank's total assets is not enough to present value of the assets are not enough to meet the present value of the liabilities is called solvency risk. And solvency risk is sort of long-term concept. But liquidity risk is sort of short-term concept. So that's why here I mentioned that liquidity risk is a risk that a company or bank may be unable to meet short-term financial demands. Understand? For example, for the today, I have the excess. I have a money of let's assume 30 million. I am having 30 million as a bank or as a financial institution. I am having 30 million. My inflows and my stock money is 30 million rupees. But I have to repay 40 million to a customers and borrowers and all obligation. I am having the obligation to repay 40 million. In that case, there's a shortage in the short term today's. So I am as an institution, I am unable to meet my all the obligations based on my available liquidity. So liquidity risk is a risk that company may be unable to meet short-term financial demands or obligations. This usually occurs due to the inability to convert a security or hard assets to cash without a loss of capital or income in process. What does it mean? It means the banks, okay, banks are having 30 million as in the cash in hand or liquid assets, but they have to pay 40 million to the customers and borrowers today. So what generally banks will do? Banks may sell or some government securities in the market and get the money, and they will try to bridge the gap of this 10 million to meet that obligations. But sometimes banks does not able to sell that securities in the market because market sometimes may be illiquid. Illiquid means there may be hardly we can sell the transaction, the particular securities. Then in that case, bank may expose to liquidity risk. Did you get the point? The unusual occurrence due to inability to convert a security or hard assets to cash without a capital or income in the process. Liquidity risk generally arises when a business or individual with immediate cash needs holds a valuable assets that it cannot rate or sell at market value due to the lack of buyers, due to an inefficient market where it is difficult to bring buyers and sellers. What does it mean? Actually, the second and third bullet point to explain that, I am giving an example. You know, in the bank, as per the central bank regulations, all the banks should have minimum liquid assets. Minimum 20% of liquid assets they should keep in their balance sheet. That liquid assets may be treasury bills, treasury bonds, and Sri Lankan development bonds, cash in hand, and some sort of commercial paper, the bills, some bills and all. I'm not sure about commercial paper. Some bills also coming under that. So they are having 20% of liquid assets as per the regulations. But they are having cash in hand only 30 million, but their obligations to pay 40 million today. So what they have to do is they will borrow from other banks. Those who have excess money, they will borrow from other bank. Or that is one option, borrow from other banks by fetching some of the government securities as a repo and a security, and they get a borrow from other bank for 1 day or 2 days or 1 week. That is one option. Or other option is they may sell the securities in the market and get the 10 million shortage. They said 10 million money to bridge the shortage. Let's assume the scenario. These people are having 10-year treasury bonds as a liquid assets. 10-year treasury bonds. It is very hard to sell these treasury bonds in the market if it is a longer maturity. The market players are in Sri Lanka. Market players are prefer short-term matches, treasury bills, or 2, 3 years, 4 years, less than 5 years treasury bonds. They don't like to buy the 10 years treasury bonds. So in that scenario, sometimes bank unable to sell that particular security on market price. In that because of the lack of buyers. In that scenario, bank may face to liquidity risk, because bank has the obligation of repay the 40 million, but bank has only cash in hand 30 million, but bank would try to sell the 10 million treasury bond into the market, but there is no buyers to buy the 10 years treasury bonds in the market. So due to that inefficient market, they are just incurring expose the liquidity risk, shortage of 10 million cash. So it could arise in that way also. So there is a market. This is called like the funding risk. Funding risk arises through the market. So liquidity risk. This is all about the liquidity risk. Before going to the non-financial risk, if you will have any question, you can clarify. I'm going very detailed manner, because if you are clear this, it will give sort of very good foundation for you all to study the other area, of course. If you have any questions, you can ask. Okay. Then I'll move to the next question. Before moving that, I just wanted to ask from you, just to clarify the things, that it will sometimes students may have the hesitation to ask the questions. So that's what I just asking the question, just to clarify the things. I said to you all, the financial risk will create a direct loss to the balance sheet. Okay? Then, if it is the liquidity risk, again, I told you that, if it is a liquidity risk, I told you that the bank or finance institution does not have enough liquidity to meet their demand. Okay, that is the definition. In that scenario, how a liquidity risk could directly affect the balance sheet of a particular bank. Did you get the question? The question is, I say that if it is a financial risk, that may hit the balance sheet of the particular bank. If it is a financial risk, that may create a direct hit to the balance sheet or the financial money losses to the bank. Okay, that is the first definition. And in the second definition, I mentioned you all that if it is a liquidity risk, they may not have enough liquidity to meet their obligation. Okay, that is the liquidity risk. Okay, in that circumstances, how a liquidity risk could create direct loss to the particular bank or financial institution, direct money loss to the particular bank or financial institution. You can answer. Actually, unmute by unmuting, or you can just through the chat box. Did you all get the question right? Okay. I say that if it is a financial risk, that will have direct hit to the balance sheet or direct loss to the balance sheet, money loss. But the liquidity risk, of course, it is a shortage of cash. Okay, then shortage of cash, how can that event could hit the balance sheet? Yeah, of course, that is the answer. Actually, when a bank when a bank exposed to a liquidity risk, then what they will do is they will sell their assets somehow in the low prices. I explained to you, they are having the 10-year bonds and they could not sell the 10-year bond in the market, and due to that there will be a credit risk could arise to that particular bank, or particular bank will expose to credit risk because they are having the 30 million cash, 40 million obligations, but they are unable to sell that treasury bonds at the market. But in that case, somehow they had to find that particular cash in a way to sell or borrow, or sometimes they may sell that particular assets, treasury bonds, at very deep discounted price, because they at the time, because the banking business is run with the confidence. If somebody lose that confidence, then it will create a lot of consequences. So somehow this bank management will try to find that money to bridge the gap. So what they will do is they will offer, sometimes they may offer high interest rate and borrow the money, or they may sell that particular treasury bonds at a deep discount. So in two scenarios, through the higher interest rate or through the deep discount, that may create a loss to the money loss to the particular bank and finance institution. Okay, so even in the liquidity risk, it may create a loss to the particular bank, loss to the particular bank and finance institution, or directly hit to the balance sheet. Okay, having that, we will move to the non-financial risk. As I mentioned to you all that there is no any limit to the non-financial risk. It is there are several subcategories involving in the non-financial risk, but generally we are considering operational risk as a main risk in the non-financial risk. Okay, operational risk. If you all are working in the bank and finance institution, you all may know about that operational risk. But we will see the first, what is the non-financial risk? The risk is the danger or possibility that can arise due to lack of system and process, compliance failures, misconduct, technology, operational challenges, and much more. That means the operational risk that will not directly involve with the cash flows or anything, but it may arise due to the lack of system. For example, for example, they have when they are procure some services or some goods, they have to get 3 quotation, or they have to have some tender procedure or something, some system. But due to the lack of system, there is no tender procedure or 3 quotation or any system, but they are buying goods in a higher price. That may create a loss, that may create a non-financial risk. Sometimes you all may ask that, okay, even in the non-financial risk, it may hit the balance. Sometimes the company or bank will lose the money, but it is not a direct hit. Due to the finally, it may end up with the balance sheet, and but comparably, the loss is money loss is low, and it is not a direct hit. So the risk of danger or possibility that can arise due to the lack of system and procedures, compliance failure, misconduct, technology, operational challenges, and much more could be considered as a operational risk. Compliance failure, for example, I can give an example to you. If it is the bank has to maintain liquidity risk 20%. 20% of liquid assets bank has to maintain. If it is the bank, for example, if they have a 100 rupee as a liability, then they have to maintain 20 rupees as a liquid in the liquid assets. That is the one of the regulations by or direction issued by the central bank supervision of the central bank. But a particular bank failed to comply with that regulations, they are maintaining only 18 rupees as a liquid assets or 15 rupees as a liquid assets. In that case, that may create a regulatory risk to the particular bank, and it is subject to the penalty. Okay, so compliance failure also may create a non-financial risk. And technology failure, operational challenges, you can understand it. And historically, as I mentioned already, historically, banks have always had to manage the financial risk, particularly credit risk, market risk. However, nowadays, banks have also deal with non-financial risk. That's what I have already mentioned. Conventionally, the banks and financial institutions gave more focus on credit risk and market risk and liquidity risk. But nowadays, they are saying that the non-financial risk also, that as important as the financial risk. Because the reputation of the finance institutions and operational, the business continuation, everything will be much important. Particularly, if you see that earlier, the system, IT risk is very less, system risk. Because there is very less of usage of IT. But nowadays, IT usage is very high. All the transactions are taking place through the internet or online. In that case, non-financial risk are become as a much important or vital risk in the risk management process of a bank and finance institution, particularly after the COVID-19. Because after the COVID-19, of course, all the people are paying all these fund transfer, doing all these fund transfer, utility payments, and all the transactions, most of the transactions through the online. So the IT risk and operational risk is getting much, or non-financial risk is getting much more important. Operational risk, legal risk, strategic risk, reputation risk, regulatory risk are some of the non-financial risk. As I mentioned already, there is no any limit for non-financial risk. It can be expanded in enormous way. But these are some of the non-financial risk, operational risk, legal risk, and all. Before going to the operational risk, if you have any questions, you can ask. Okay, then we will move to the operational risk. Operational risk is a possibility of loss resulting from inadequate or failure of procedure, systems, or policies. So generally, the operational risk could arise due to 4 reasons. The first one is system failure. That, of course, everybody knows that if we are having some software system and all, core banking system or any other system, that due to that failure, system failure, the operational risk could arise. Second one is process. Process in the sense, if one person has to, failure of the process means, as I mentioned, for example, we can say that if a person has to make the payment, it has to be checked by somebody else's and has to make sure that the calculations are correct. But due to the failure of the process, the operational risk could arise. I can give a very typical example. If you are working in the financial institution, I can give a very typical example, the passwords. Generally, if the payment teller make the payment beyond certain or more than certain amount limit, then he has to get approval from the second officer. The second officer has to approve through the passwords. But some banks, I also observed, some banks, the second officer gave the password to the teller for the easiness. Then teller used the second officer password and make the payment. But it may create an operational risk to the particular bank and finance institution. But most of the banks sharing password is prohibited. But due to the lack of process, sometimes this may happen, or failure of the process, this may happen. So sometimes the second officer, if the second officer share the password, then the teller may create some operational risk. Or sometimes it may be error. It may not be the fraud, it may be an error. But there may be failure of process may create operational risk. And people. People, of course, it can be error or fraud. The people get together and may get involved in the fraud activity. So that also may create a sort of operational risk to the bank. And external events. You may think about that, how external event may create operational risk. There are possibilities. For example, you are purchasing a software from a particular vendor. Due to some COVID reason or something, the particular vendor closed down and they are not ready to, they are not in a position to maintain that system. Okay, due to that external event, this bank may expose to the operational risk. They could not maintain their system properly, and there are some issues in the system that create an operational risk. Or otherwise, for example, if it is a production company, you are depending on one supplier. Due to some reason, that supplier went into the bankruptcy condition. They could not supply the particular material. It's a very rare material. In that case, the external event create an operational risk to the particular bank, particular production company. Likewise, there may be external events also. So operational risk, that is what you have to keep in mind. Operational risk could be created through 4 reasons. One is system, other one is process, other one is people, other one is external event. All these 4 reasons may create an operational risk to the particular bank or finance institution. That's what in the second sentence I mentioned. It occurs mainly due to employees' error, system failure, fraud, or other criminal activity. Any event that disturbs the business process may call as an operational risk. Yeah, before moving to the legal risk, if you have any question, you can ask. Okay, then I'm moving to the legal risk. The earlier, sometimes before in the sense, the maybe 5 to 10 years before, the legal risk also considered as a part of the operational risk. But now the modern theory says that legal risk, or categorize the legal risk as a separate non-financial risk. I say to you all clearly, the non-financial risk has several categories. That important category is operational risk, and other than that, there are legal, strategic, and all other categories. Earlier, This legal risk also considered as a operational risk, but modern theories divide the legal risk into the separate sector. The legal risk is the risk of financial or reputational loss that can result from lack of awareness or misunderstanding or reckless indifference to a law and regulations applied to the business, its relationship and process of product and services. That called legal risk. Because it may be due to the awareness or misconducting, they are exposed to some sort of risk. Even 2-3 days before, there may be there was a press release made by the central bank, FIU, Financial Investigation Unit, particularly. They made an announcement that last quarter they have imposed penalties for 2 banks for misconducting FIU rules or regulations. Maybe due to the lack of awareness or mainly due to the misunderstanding that that could occur. But those type of risks create a reputational loss, financial loss also, because they impose some penalties. I saw 1 million and 2 million. They impose some penalty, but for a bank, it's not a big money. But still, it's a financial loss. As well as on top of the financial loss, reputational loss is very important thing. So, due to the lack of awareness and misunderstanding of particular law, they may expose to the risk that is called legal risk. Actually, don't confuse with the regulatory risk. That is something different. This is due to the understanding, misunderstanding or awareness or not comply with the particular law or regulations applied to the particular business. Here, FIU law has not been followed by the particular 2 banks. So it may create a reputation risk. So those type of risks are considered as a legal risk. Presently, it is considered as a part of the operational risk. One of the prime reasons why the legal risk is associated with the operation risk involved fraud, since it is recognized as a most significant category of operational risk events and considered to be a legal issue as well. Actually, not presently, it's a past. In the past, it was considered as a part of the operational risk. Sorry, students, please correct it. It's in the past. Okay, so that is about the legal risk and reputation risk. Okay, there are 2 different concepts. One is reputational risk, other one is reputational loss. The reputation, in some instances, reputation losses could be considered, but the reputation risk refers to the potential of negative publicity, public perception, or uncontrollable events to have an adverse impact on company's reputation, thereby affecting its revenue. That is called reputational risk. For example, we can say the reputation. There are several examples can be given to the reputational risk. For example, I can take an example. A particular bank's customers' informations are getting leaked. For example, in a particular bank, if you get the credit card and that credit card informations are getting leaked to the competitors and all, there may be some rumors going on through, or some news going through in the social media and all. That may affect the reputation. That may create a reputational risk to the particular bank. And it will affect the revenue. Why? Because the people will not go for the credit card of the particular bank. Okay, then that may create a revenue loss to the particular bank. So, and reputation as well. And it is very important to very difficult to control the reputation risk. You have to keep in mind the financial, the reputation risk is a greater than the financial losses, because the reputational risk may create a very high impact to the particular bank's revenue as well as particular bank's reputation, particular company's reputation. You will make recall that time to time, sometimes there may be news about these hospitals and all. If the patients go there and they have mistreated and their treatment was wrong and all, that sort of news may create a reputational risk to a particular hospital, and it may affect the revenue of that particular hospitals in the long run and short run as well. So those type of risk are called the reputation risk. There are numerous reasons for the reputation risk, including outside adverse events, workplace practice, data retention, failures, product recall, or bad financial statements. These all will create a reputation risk. Sometimes, if you not in Sri Lanka, of course, in some foreign countries, sometimes some car companies, they recall their product because of some default in the particular cars. So that may create a reputation risk. A negative corporate reputation harms the client and investor trust, erodes your customer base, and hinders sales. A poor reputation correlates with the increased cost for hiring, the retention, which discreate the operating margins and prevents a higher returns. So reputation risk may create due to the bad negative news or publicity spread throughout the stakeholders or among the stakeholders of the particular or general public of the bank. So that is called reputation risk. It may create financial loss or reputation loss. Okay, so there are two concepts you have to keep in mind: reputation risk and reputation loss. So the reputation risk is due to the negative publicity. And regulatory risk is again, it's related to the legal risk, but something different. Actually, regulatory risk is a change of regulations and law that might affect the industry or business. Such changes in regulations can be significant changes in framework of the industry, changes in cost structure, etc. For example, when the Basel III introduced, it may require more system enhancement that may create a cost or that may create a losses. So that is can call as a regulatory risk. Or sometimes the regulator may say that you may have to bring more capital to the business. In that scenario also, the bank or particular company may struggle to bring that capital. It may be highly cost. And sometimes it may affect their business continuity as well due to the change in regulations. That not only the financial regulation, sometimes in the environmental regulations. For example, we can say that the polythene, the land sheet cannot be produced by or used from time to time. They're from January or from August. Then in that case, the company which have their co-product as a producing land sheet will have an issue. They may have to discontinue their business. So those type of new regulations may create a regulatory risk. This is also considered as a non-financial risk. Financial institutions face regulatory risk with respect to capital requirement, NPL classification, liquidity requirement, services and product. They are allowed to engage in the implementation of accounting standard. So those type of risks are called the regulatory risk. And strategic risk, of course, everybody knows that strategic risk because these banks and financial institutions may have some strategic directions. And every year they are preparing the strategic plan. So strategic risk is that risk that fail to business decision or lack of thereof may pose to the company. Their strategic decision or business decision, lack of the fail to the business decision may create a loss. Strategic risk is often major factor in determining the company's worth, particularly observable if the company experiences a sharp decline in the short period of time. Due to this and its influence on the compliance risk, and it lead to a factor in the modern risk management. So in the modern risk management, sometimes the strategic risk may involved in the business continuity as well, may affect the business continuity of the particular bank and financial institution. And finally, we can move to the impact of risk in the institution. This is, I think, I have explained to you all already. There are 4 reasons for the non-financial risk, particularly operational risk. What are the 4 reasons? People, procedure, system, and external events. You may recall this graph, these things, operational risk. People, system, process, and external events. These 4 reasons, due to there are, I think there's a typo mistake. There are 4 causes. 4 causes that could create a risk event. People, procedure, system, and external events. 3 types of losses could arise from a risk event: financial losses, reputational losses, fail to achieve the objective, or business continuity. So, in any non-financial risk, there may be 4 reasons and 3 losses could arise. So, that is about the non-financial risk. Understand? So actually, if something if something asks what are the causes for the that create a non-financial risk, you have to write the 4 reasons, 4 causes: people, procedure, system, and external events. And 3 losses, as I explained to you all: financial losses, reputational losses, failure to achieve the objective. These all are applicable to non-financial risk, or particularly operational risk. But this is not related to the financial risk. Financial risk, of course, that only create mainly financial losses. Okay? Any questions you all wanted to ask from me? Yeah, there's a question there, sir. Does the non-financial risk result in changes of P&L or balance sheet? How does it differ from the financial risk in terms of impact of P&L and balance? Yeah, exactly. That is an obvious doubt. I say that because actually I have already explained to you as well. The financial risk, we are saying that any risk that could create a direct losses to the balance sheet and P&L. But in the non-financial risk also, that may lead to the financial losses, because here I say that there's a loss in the financial losses. Then how can we differentiate these two? Because the main difference of the financial risk that will hit the balance sheet, directly hit the balance sheet. But you are saying again, even non-financial risk also may create the financial loss. So how can we differentiate? Actually, you have to keep in mind 2 things. The first one is I use the word direct losses. The financial risk may create a direct impact on balance sheet or P&L. Direct impact. And second one is the losses are the sizable or significant. For example, if it is a NPL, or if it is a NPL or any non-performing credit risk, or if it is a market risk, the financial risk size is significant. But in case of non-financial risk, there may be some losses, but that is not direct losses. Maybe it may affect, for example, if we take the reputational risk, it may affect the reputation. That may affect again the revenue and the P&L. So indirectly it may hit the losses. That is one. The second one is that may not have that much of, okay, the reputational risk, of course, is significant, but compared to an NPL risk, the credit risk or any interest rate risk or something, it is not that as much as the significant. But there may be significant, but the first reason is the main reason you have to keep in mind, because significant, of course, we can debate in both ways. The first one is it is not a direct hit to the P&L and balance sheet, so non-financial risk. But if it is a financial risk, that will directly affect the P&L and balance sheet. That is the difference actually. I think you would have got the point. Okay. If you have any questions, you can ask. Otherwise, actually, we have to start to the new section, the risk management framework. Of course, that is something different section. Because due to the time constraint, I can't finish it. So I'm thinking to take it to the other class. So if you have any question, you can ask in the previous section. So today we have seen about, we have discussed about what is risk and risk management process, and then risk management, and then risk management process, and then we have segregate the risk into the two categories, the financial risk and non-financial risk. Under the financial risk, very briefly, we have checked about the credit risk, market risk, and liquidity risk. And then we have checked about, we have discussed about the non-financial risk. Under that, there are several categories. And then with that point, I'm like to stop the class today. And if you have any question, you can ask, or otherwise we can meet it on next class. And I will continue this tube.